A Hollywood actor quietly buys into an obscure gin brand. Just 24 months later, that $2 million bet turns into a headline-grabbing $610 million exit, with single-digit millions skyrocketing to a near 100 times return on investment. The official story celebrates genius marketing, but the real secret is an angel investing playbook designed to crack stagnant industries with creative control and operational speed. What happens when sweat equity outpaces Wall Street money? And can this strategy of 100 times in 24 months actually be repeated? In February 2018, Ryan Reynolds took an ownership stake in Aviation Gin, stepping into the role of co-owner and creative director. The brand had been around for over a decade, launched in 2006, and acquired by Davos Brands in 2016. Aviation was not a household name. It sat quietly in a crowded spirits market, lacking the cultural cachet and distribution muscle of global gin competitors. Davos remained the majority owner, but Reynolds' entry brought more than capital. He secured a formal operating role, giving him direct influence over the brand voice and marketing direction. The spirits industry, especially the super-premium gin segment, was primed for disruption. Incumbents leaned heavily on traditional advertising and legacy distribution, often missing the mark with younger consumers. Aviation, by contrast, had a quality product, but little brand awareness and minimal share of the super-premium category. Reynolds recognized that gap as an opportunity for arbitrage. His investment thesis was simple: take a proven but overlooked product, apply a new marketing engine, and drive growth through cultural relevance rather than media spend. Throughout 2019, the numbers validated the approach. Aviation United States sales volumes grew over 100% in a single year, outpacing every major competitor in the segment. Industry analysts reported that aviation accounted for nearly 40% of all super-premium gin growth in the United States that year. Sales reportedly doubled from $20 million to $40 million, a leap rarely seen in mature spirits categories. This growth was not fueled by massive budgets or retail blitzes. Instead, Reynolds' team, anchored by his boutique agency M.V.N.O, engineered a series of digital-first campaigns that cut through the noise with humor and self-awareness, capturing media attention and consumer interest at a fraction of the cost. Reynolds' operational involvement was central. As creative director, he controlled the brand voice, oversaw campaign development, and approved content. The small, agile team could respond to cultural moments in real time, giving aviation a speed advantage over legacy competitors. This hands-on approach allowed for rapid experimentation and direct feedback from the market, compressing the time from creative idea to measurable sales impact. By the end of 2019, aviation trajectory had shifted dramatically. The brand moved from obscurity to the number 2 spot among super-premium gins in the United States. The performance spike caught the attention of industry analysts and, more importantly, strategic acquirers looking for brands with momentum and cultural heat. The groundwork was set for a headline-making exit, but the real inflection point was still to come. A moment when creative agility would collide with viral opportunity, amplifying the brand value far beyond what traditional marketing could deliver. That catalyst arrived in the final days of 2019, setting the stage for one of the most talked about exits in spirits deal-making. December 2019 brought a flashpoint few brands could engineer, let alone exploit. Peloton's holiday ad, featuring a woman's awkward fitness journey, drew a tidal wave of backlash, memes, late-night jokes, and headlines dissecting every frame. While most marketers watched from the sidelines, Reynolds' team at maximum effort saw a once-in-a-year opportunity. In less than 4 days, they tracked down the original actress, wrote a script, shot, edited, and released The Gift That Does Not Give Back. The spot opened with the same actress, a martini in hand, flanked by friends reassuring her, "You are safe here." The cultural callback was immediate. Within hours, millions had watched, shared, and commented. CNN, CNBC, and Ad Age called it a masterclass in real-time marketing. The ad cost a fraction of a traditional campaign, yet aviation's brand awareness soared. Earned media estimates reached 8 figures, all from a single rapid-fire response. That 4-day window was not just a viral win, it was a valuation event. The speed and precision of the parody became the proof point for Reynolds' creative control thesis. In a market where spirits brands spend tens of millions on slow-turn television spots, aviation leapfrogged with a nimble team and a willingness to hijack cultural moments. The brand's momentum accelerated, and strategic buyers took notice. Less than 8 months later, Diageo announced its acquisition of Aviation and its parent Davos brands for up to $610 million, $335 million in cash, with another $275 million tied to a decade of performance-based earnouts. Mechanics of that deal matter. Diageo's structure, nearly half the value contingent on future results, meant Reynolds and the other sellers had to keep pushing growth long after the headline hit. Public filings never reveal the exact earnout hurdles or how much Reynolds ultimately realized, but industry norms suggest targets tied to sales, distribution, and EBITDA. For the purpose of modeling, the documentary lays out a sensitivity table. If Reynolds' stake ranged from 5% to 20%, and his original check was anywhere from $500,000 to $5 million, the multiple on invested capital lands between 15 times and 60 times, possibly higher if he put in less cash and realized the full earnout. Hitting the full $610 million would push a 10% stake to $61 million. At the low end, a 5% share of just the upfront would net $16.8 million. Either way, the result dwarfs typical private equity returns, especially given the compressed hold period, just over 2 years from entry to exit. Lesson: the Peloton parody was not a fluke. It was the outcome of a creative machine built for speed and cultural fluency. The numbers that followed, deal value, sensitivity grid, and multiples, trace directly back to that 4-day sprint. For investors, the lesson is clear. Operational involvement and creative agility can turn a modest stake into a generational win. But to validate the playbook, Reynolds needed to prove it was not a one-off. The next test would come in a completely different sector, with a brand that could not be further from gin. In November 2019, Ryan Reynolds entered the wireless sector by acquiring a significant ownership stake in M.V.N.O. M.V.N.O became his entry point into telecommunications. Unlike the legacy spirits business, the mobile market was dominated by national carriers. Mint operated as a mobile virtual network operator, known as an M.V.N.O, selling prepaid plans over the infrastructure of T-Mobile. The M.V.N.O model strips out the cost of building cell towers and retail stores, allowing Mint to focus entirely on digital acquisition and direct-to-consumer sales. This focus made digital performance the core advantage. That meant customer acquisition cost, or CAC, could be kept dramatically lower than traditional carriers, who spent billions on advertising and retail presence each year. The founders of Mint, led by David Glickman and Rizwan Qasim, had already built a lean, digital-first operation. Their approach emphasized transparent, low-cost plans sold primarily online, with a brand voice that cut through industry jargon and complexity. Even with solid fundamentals, Mint was a challenger brand, an underdog in an industry notorious for high churn and aggressive price competition. Reynolds saw the same pattern he had exploited in spirits: a quality product, an under-leveraged brand, and incumbents relying on stale marketing and bloated cost structures. Reynolds did not just invest capital. He took on creative leadership, embedding his agency Maximum Effort into Mint's operations. The playbook was familiar: use humor, transparency, and cultural fluency to drive earned media and viral reach, bypassing the 9-figure ad budgets of the big 3 carriers. Mint's campaigns poked fun at wireless pricing tricks, highlighted the absurdity of hidden fees, and positioned the brand as the honest, relatable alternative. That honest voice cut through noise and earned free publicity. This operational involvement was not window dressing. By serving as the face of the brand and controlling the creative output, Reynolds helped Mint sustain customer acquisition cost, CAC, well below industry norms. Control of creative execution proved decisive. The result became a flywheel. Digital-first marketing lowered CAC, which allowed for lower prices, fueling subscriber growth, and making the brand increasingly attractive to strategic acquirers. The flywheel accelerated value creation. Industry data at the time showed a wave of carrier consolidation, with large players seeking digital assets that could scale without heavy capital investment. Mint fit that mold: efficient, fast-growing, and culturally relevant. Consolidation made strategic exit plausible from day one. For Reynolds, this role was more than celebrity endorsement. It was an application of private equity logic, operational leverage, platform economics, and a clear path to exit built from the start. Private equity thinking turned a small stake and creative control into a strategic asset. March 2023 brought a new headline. T-Mobile's agreement to acquire Mint Mobile's parent company, Kaina Corporation, was announced for up to $1.35 billion. The deal combined 39% cash and 61% T-Mobile stock, with final consideration subject to closing adjustments and performance milestones. After regulatory review and FCC approval, the transaction closed in May 2024, capping a hold period of roughly 4.5 years from Reynolds' entry to exit. By the time of the sale, Reynolds' ownership in Mint Mobile stood at about 25%. That translated to a personal payout of approximately $300 million, an extraordinary amount by any measure, especially for a minority owner who joined after the business was already established. The payout was not just a single windfall. It was the product of operational involvement, creative leadership, and the ability to turn a challenger telecom brand into a must-have asset for a national carrier. The structure of the deal echoed the private equity playbook, a mix of cash and stock, with part of the value contingent on future performance. While the $1.35 billion headline number grabbed attention, the actual realized value at closing was just under $1.3 billion, reinforcing the importance of deal mechanics and performance risk. Reynolds' exit multiple on invested capital is not public, but industry sources place his initial check in the low to mid 8-figure range. The result is a high double-digit return over a 4 to 5 year hold. That is a top decile outcome by any private equity or venture standard, even if the multiple does not match the compressed, triple-digit return on investment achieved with Aviation Gin. The contrast is clear. Aviation delivered a higher multiple in a shorter window, while Mint produced a larger absolute dollar exit over a longer hold. Both cases validate the core thesis: operational involvement and creative control can drive outsized exits even when industries, hold periods, and payout mechanics differ. For a portfolio investor, this is the power of diversification: uncorrelated sectors, different exit timelines, and independent performance drivers, all compounding to produce asymmetric risk and reward. T-Mobile's logic was simple: acquire a digital-first brand with low customer acquisition cost, proven growth, and a cultural edge. For Reynolds, the Mint exit confirmed the playbook worked beyond spirits. and it set the stage for a platform approach to value creation. In 2018, Maximum Effort launched as a lean creative agency built around Ryan Reynolds and a handful of trusted collaborators. The team operated with a startup mentality, running everything from campaign ideation to production in-house. This was not a traditional agency chasing big retainers. Instead, Maximum Effort generated revenue through a mix of equity deals with Reynolds' portfolio companies and cash fees from outside clients. The agency's economics were simple: keep overhead low, move fast, and let creative work finance the next round of equity bets. The Match campaign in late 2020 showed how this model could scale. Maximum Effort produced a spot titled "Satan Meets 2020" for Match.com that exploded online, racking up 14 million views in the first 24 hours, and over 5 billion earned impressions by the campaign's end. These were not just vanity metrics. The campaign generated significant fee income for the agency, while also proving Maximum Effort could deliver viral hits for brands Reynolds did not own. That cash flow mattered. It funded creative salaries, covered production costs, and, critically, let Reynolds take equity stakes in brands like Mint Mobile without relying on outside capital. By June 2021, the agency's platform value attracted attention from M.N.T.N, a performance television technology company. M.N.T.N acquired Maximum Effort, bringing Reynolds on as Chief Creative Officer. The deal created liquidity for Reynolds and his team, while embedding Maximum Effort's creative engine inside a scaled ad tech stack. The result was a vertically integrated platform that could generate revenue from agency work, amplify owned brands, and recycle profits into new investments. This platform approach turned creative fees into a flywheel for financing and scaling equity bets, and it laid the groundwork for the next experiment, treating a small sports club as both a brand and a media asset. February 2021 brought a new kind of acquisition: Wrexham AFC, a fifth-tier Welsh football club with more than a century of history, but little cash and even less global attention. Ryan Reynolds and Rob McElhenney, acting through their joint vehicle, closed the deal for roughly £2 million, roughly $2.5 million at the time. The club's profit and loss statement showed a stark picture: operating losses of over £10 million, or roughly $13 million, in the first 3 years under new ownership. Instead of cutting costs, the duo poured money into the squad, stadium upgrades, and a full-time media operation. The club ran deep in the red, but the real play was happening off the pitch. The launch of the FX and Hulu docuseries Welcome to Wrexham turned the team into a global brand. Streaming rights, international sponsorships, and merchandise sales grew far beyond what a typical League Two side could expect. Attendance at the racecourse ground jumped to near sellout levels, with fans traveling from around the world. The club's annual turnover, once just a few £1 million, reached double digits by 2023, driven by media and commercial deals that would have been unthinkable before the takeover. Despite the mounting losses, sports finance analysts began assigning Wrexham a valuation many times the original purchase price. Estimates now cluster around $100 million, based on revenue growth, global brand reach, and the option value of future league promotions. No formal sale has taken place, but on paper, that is a 40 times uplift in enterprise value, achieved while running negative cash flow. The Wrexham paradox is clear: a money-losing club transformed into a media-powered asset, where brand equity and global attention outweigh short-term profits. For Reynolds and McElhenney, the numbers show that in the right hands, even red ink can be a sign of value creation. Speed, operational involvement, and a built-in exit plan form the backbone of this investment framework. Each pillar is designed to compress risk and maximize upside. But the real test is whether these rules hold up under scrutiny. On one side, private equity analysts point to the repeatability of this playbook. Find a product with traction, step into a hands-on operator role, and engineer a strategic exit from the start. On the other, skeptical voices warn that headlines mask the survivorship bias. Most celebrity-backed brands never reach a billion-dollar exit, and the few that do are exceptions, not the rule. A governance expert would flag the need for formal controls. Related party transactions, like an owner's agency billing a portfolio brand, demand board-level disclosure and independent review. Without clear separation between creative fees and equity upside, conflicts can quietly erode value or lead to regulatory headaches. The audit lens extends further. Is there a written conflict of interest policy? Are fee structures transparent to all stakeholders? Can the operating team realistically scale creative attention across multiple brands without diluting results? For investors, these questions become a checklist. Does the product have established distribution? Is there a clear path to a strategic acquirer? Will you or your team take a true operational role or just write a check? Can you generate earned media without relying on global celebrity? Is the earnout structure realistic, and what happens if targets are missed? Are all related party arrangements disclosed and governed? The answers separate sustainable value creation from headline-chasing speculation. As with any investment, the story is only as strong as the controls and repeatability behind it. A sound framework is only as good as its weakest link, and the best deals withstand outside audit. Today, private capital moves faster and smarter than ever. As celebrities and operators blur the lines between investor and brand architect, the edge shifts to those who build, not just buy. The next 100 times return will not come from passively waiting. It will come from spotting the overlooked, moving with conviction, and rewriting the playbook before anyone else. Which side of the table will you be on?